purchase and execute a call option. It's really interesting because, in fact, now we're going from something of the normal, the stocks and bond purchases, and it's a matter of, okay, you buy a share of stock, you understand what that is. Now you're going to buy the right to buy that share of stock at a certain price by a certain date. You're not going to own the stock. You're going to go through and buy the opportunity to buy it at a certain price, a certain date. It's a lot cheaper to do that. It's a lot riskier to do that as well. You may lose all your money because the circumstances that would benefit you to buy it at that price may not exist at all. You're gambling on what's going to be happening in the future, which is what options really is all about. So let's look at the aspects of purchase and execute a call option. A call option gives the buyer a right, but not the obligation to buy an underlying asset at a specified price on or before the specified date. Really, we call these derivatives because you're deriving the value of the option from the actual thing that you don't really own. So you're buying it or deriving it from that value. So let's look at a couple of things. A call option, a lot of times you buy it because you want to hedge against risk, or you want to have an opportunity, or you want to have control over something that you normally wouldn't be investing your money. Let's say, for instance, you have a portfolio and you want to get an opportunity to buy stock, and the stock is currently selling at $2,000 a share. Well, normally you buy stock in blocks of 100. You don't happen to have $200,000 laying around your back pocket right now because your wallet wouldn't all fit in there at the same time. But that being said, you're sitting there looking at that thinking, oh, I think that's going to go up. I think it's going to go up. So you can sit down there and buy the opportunity to purchase that if it does go up at a fabulous price, just for a few dollars. You don't have to come up with $2,000 a share. You might have to come up with $5 a share. What an opportunity, but you're not owning the stock, at least not yet. Just if it goes up, then you can sit there and exercise the strike price on it and buy the stock at your strike price. So that being said, let's look at the aspects of, let's do an example. 100 shares of stock, strike price is $100 a share. Right now it's selling for $80 a share. Okay, so you're going to buy a 1 month expiration date at $5 a share. Now, for a stock to go from $80 to $100, that's an awful lot of deals, but really you're looking for it to go above the $100 because you've already paid for that, but you can buy it for $100. So all of a sudden, something miraculous happens and boom, it goes from $80 to $110 a share. Ta-da! Okay, you're going to strike it. You're going to buy it for $100, and you are now a wealthy person. Well, are you a wealthy person? Let's look at the numbers. Okay, so you sell it, you buy it at the $100 before the expiration date. The buyer of the call option exercises the option to buy it at $100, and the stock is now at $110. So the buyer exercises the option. The seller has to deliver the shares, and then all of a sudden the person buys those 100 shares, okay, and they turn around and they sell it at the market price, and they're going to be making money off each individual once. Okay, so that being said, they're going to make really 110 minus the $5 fee they paid for the call option. So they're going to make $5 per share of stock. That's a nice, healthy investment. So you doubled your money in 1 month. You paid $5 and boom, you sold it for a $10 profit overall. Subtract your cost, you made $5. The person that owned the stock, okay, they owned it, it was $80 a share. They sold it at $100 a share. They still made $20 a share. They lost out on another $10 by taking the risk of selling that, but still 80 to 100 is $20 a share, and they made $5 above that. They really only lost, if you want to conceive it this way, $5, but they really gained $25 a share. So you're looking at different options over here. In this case, it's a win-win scenario. So why buy a call options? They're used to generate income. The person that sold the option made money, and the person that took the risk to buy it at a certain price, they made money, and that premium could be a significant source of income. A lot of times you'll see day traders diving into this thing, but usually a day trader is going to just liquidate their stuff by the end of the day. But that being said, if you have that mentality to sit down there and live on the edge, it's really interesting to watch, and you watch on a daily basis. Don't buy these things unless you're watching them on a daily basis. It's a big deal. You don't know what happened. All of a sudden, it might be well above your strike price one day, and the next day it dropped because something happens in the economy. So I recommend never going out into the option world unless you're going to track your stuff on a regular basis. So how to purchase one? To purchase a call option, you need to open a brokerage account that allows for options trading. Not all of them do. Okay, once you have it, place an order. You want to be able to have the ability to buy stock on margin as well. So you want to have a well-established company that you have a relationship that you can actually buy stock on margin, because you're going to buy it. If you're going to buy an option, you may want to exercise buying 100 shares of $2,000 share stock, that you had the ability to sit down there, buy it quickly and sell it, maybe even the same day, because you're buying options. So you want to be able to have the flexibility and the cash flow to make that happen. So you may want to open a margin account and then make a decision as to what you want to buy, a buy or a put. We'll talk about the put a little bit later. A put works in the opposite way, that you're betting the stock is going to down. We call that short selling. So we'll talk about that in a little bit. So you're going to pay a premium to the seller for the option for that right. It's going to have a strike price of what you can buy that stock for. It's also going to have an expiration date. Really, if you're into this market over here, you're better off getting a 45-day or 60-day date, and that way you can watch it instead of a 30-day date, because then it's almost like it's a panic buy. Just depends where you're at. Once you place your order, your broker buys the option contract for you, and you'll pay a premium to the seller for the option that's right. You'll also pay a broker fee as well. Okay, and then so really buying options is risky. If the price of the underlying asset doesn't go up or it goes down, you could lose money on your investment. That's why this is a risky investment. For example, you buy a call option to stock and the price of the stock goes down. You're not going to exercise it. You're not going to exercise an option to buy for $100 if it dropped down to 75. So it's going to expire and you lose the whole thing. The person that owned the stock, they get some money out of it. But if it goes down or it stays exactly the same at $80, they gain money by taking the risk of selling it. Okay, but they've actually made a little bit of money that they weren't going to make otherwise. So being the one that owns the stock has a certain element of risk, because you're risking the regular risk of a stock market, and you're also getting extra money by selling the rights for somebody else to buy your stock at a certain price. But the reality is it's a safer position than a person actually buying it. So understand the risk involved. Do your research before you buy a call option. Know what's happening out there. It's important to know about the underlying asset and the factors that could affect the price if it goes up or down. That's your job to figure that out. Choose the right options. They're not all created equals. Some options are riskier when you're choosing the options. So look at the volatility of the underlying asset, and the more volatile the underlying asset, the riskier the option will be, or the riskier usually means more profit. So it depends where you're at. For the volatility, the implied volatility option really is the market expectation of how the underlying asset will move, but you also have to deal with the market itself. Is the market as a whole moving bullish or bearish? And at the moment, this depends on what's going out there. And then look at the time to expiration. As to the shorter expiration time, the riskier, because you have to have the change that you're looking for really having that opportunity to happen. So that's why I recommend 45 or 60, but that's your call. A lot of times for success, a stop loss order, because in order to sell an option, the price of the underlying asset reaches a certain level. You put that in, you pre-program it, kind of like those big giant program traders. Okay, this is your opportunity. Okay, manage your risk. Make certain when you're buying call options, you do it by only buying options that you can afford to lose. Don't put all your eggs into one basket. That's the idea of having financial diversity in your portfolio. Buying call options is risky strategy, but it can be very profitable if you play your cards right, play your knowledge right, and do a good job in studying what's going to be happening in the future market. But even the best study doesn't always pan out the way you expect it to. So pay attention to it. This is risky. It's interesting. It's exciting. It's an adrenaline ride, but adrenaline works for fear and terror as well as joy and happiness as well. So that being said, be careful on this option. However, it is intriguing. I recommend experimenting with it in the aspect of if you have a solid portfolio. But that being said, I'm not a financial advisor. Go find your financial advisor, pay them to watch your money, work with you on the process, and just go and experiment as to your comfort level and make certain that all investments have risk with them. Take care.